Welcome to our masterclass on IFRS 9. IFRS 9 made simple. We have already looked at IAS 32 financial instrument presentation. As I explained in that class, if you understand IAS 32, it will make IFRS 9 much easier for you. So if you've not watched that video on IAS 32, I urge you to go and watch it and then come back to join us in this class, where we look at IFRS 9 and we make it very simple for everybody to understand. Before we delve into IFRS 9, it is expedient to explain that the standard that existed for financial instruments in the past was IAS 39. IAS 39 was replaced by IFRS 9 due to huge criticisms that followed the 2008 global financial crisis. Now, the argument was that IAS 39 was too rigid, was too complex, and also the incurred loss model was not a very good one, which made people to look backwards rather than forward. And so IFRS 9 financial instrument was created by the International Accounting Standard Board to replace IAS 39. And it is believed that IFRS 9 is easier to understand and it is more forward-looking rather than backward-looking. So if you're ready, let's demystify IFRS 9. My name is Echela Okori, Finance Simplifier. Okay, for IFRS 9, financial instrument, there are two tests that decide everything. So if you understand these two tests, then you don't have a problem understanding IFRS 9. So let's answer the question that every accounting student is asking. Students are asking, how does IFRS 9 decide where to classify a financial asset? So that is what we're going to demystify in this class. And the answer is simple. If you can understand and apply these two tests, then this decides everything for financial instrument. So memorizing is unnecessary. You don't need to do that. What you need to do is to understand these two tests. So under IFRS 9, you only need to answer two questions. If you answer them correctly, then it is as good as classified. You have classified your financial asset correctly. So in the next slide, we shall look at one of these two questions. So let's look at question number one. Question number one is very simple for IFRS 9 financial instrument. The first question you need to ask is, what is the company's business model? What is the company's business model? When you hear business model, it sounds technical, but it's not. It's just asking a simple question. I mean, the question is, why did the company acquire that financial asset that it holds? So the company holds a financial asset, or the company acquired a financial asset. So the question you are asking is, what is the company's business model? And by asking that question, you are simply saying, why did that company acquire the financial asset in the first place? So there are three ways that we're going to look. There are three models that we're going to look at, to answer this business model. There are three ways. So but before I look at them one after the other, I want us to look at this analogy. You have two individuals. One acquired a car to transport himself to work and back home. So that is why he acquired the car. Then the second individual acquired the same car, but he is more of a collector. He acquired that car to see if the car will increase in value, and then he will sell it and make a profit. So you can see that it is the same asset, but the intention behind the acquisition differs between these two persons. So that is how financial asset is, and that is how financial instrument is, and that is how IFRS 9 can be understood. So under the first question, the business model question, we are looking at it in this way. Why did you acquire the financial asset in the first place? So model number one, business model one, is hold to collect. So you can acquire a financial asset just because you want to hold it to collect. What do you want to collect? You want to collect principal, you want to collect interest. So The first model is hold to collect. So if the company's objective is simple, just to collect the contractual cash flows until maturity. I mean, like a company, maybe a bank, grants a loan to an individual or to another company, and then the contractual agreement is you pay this interest, a certain percentage, and then at the maturity period, if it's 1 year or 2 years or 3 years, as the case may be, then you also pay back the principal. So what is the reason? Why did that company acquire the financial asset? It acquired that financial asset simply to hold it and to collect. So that is business model 1. You hold to collect. Collect what? Collect interest and collect the principal upon maturity. Okay, let's look at the next model. Business model 2 is hold to collect and sell. Hold to collect and sell. Business model 1 is hold to collect. Just hold to collect. Collect interest, collect principal upon maturity. Now, business model 2 is hold to collect, like business model 1, but also not just to collect, but also to sell. Okay, so imagine that another bank this time around keeps investments until maturity, and at other times it sells them when interest rates change or when it needs liquidity. So it wants to keep this investment until maturity. That is the plan. But if there is a favorable rate, it may decide to sell it. Also, if it runs into liquidity issues, liquidity challenges, like the company is cash strapped, the company will also decide to sell. So that company is not just holding to collect like the first company. This company is holding to collect and sell. So in that case, we say the objective of that company is achieved by 2 things: by collecting contractual cash flows, that is interest, okay, and also selling financial assets. So this is holding to collect and sell. I hope this is clear. The first company is holding, that's the first business model, is hold to collect. Collect what? Collect contractual cash flows, that is interest, and upon maturity, you collect your principal back. This second company is holding to collect also, but also the company wants to sell if it has liquidity problems or if there is a favorable interest rate that will bring profit to the company. So this company is holding to collect and sell. Now let's look at the third model, business model 3. Business model 3 is anyone that does not fall into category 1, does not fall into category 2. That is not business model 1, it's not business model 2. Then it will fall automatically into business model 3. So that is everything else apart from business model 1 and business model 2. So imagine a trading firm buys government bonds today, hoping to sell them next week for a profit. You bought it today and your plan is to sell it next week to make a profit. So it is not holding, that company is not holding to sell, okay? It's not holding to collect. So the company is not interested in collecting interest over many years. No. Its objective is to profit from price movement. Okay? That company is just looking at, it wants to profit from what? The objective is simple. I want to make profit from price movement. If their price changes, once it is favorable, I will sell. So this does not fit into the first one that is holding to collect, or the second one that is holding to collect and sell. So automatically it falls into business model 3. Okay. So now let's look at question 2. Remember, I said there are 2 questions you need to ask. The first question we said is, what is the business model of the company? So question number 2, we're saying, what do the cash flows look like? First question we're asking, we've looked at the first question and we've broken it down into 3 business models. Okay. The first question is, what is the business model of the company? Question number 2 is, what do the cash flows look like? So this is going to pass what we call SPPI. SPPI means solely payments of principal and interest. Solely payment of principal and interest. So if it passes this test, IFRS 9 is saying you have to ask this second question. what exactly will this asset pay you? What is the cash flow? That is the second question. And this is what we call the SPPI test. So now I'm going to say SPPI stands like one technical thing. It's just a jargon. It means solely payment of principal and interest. And because I am the finance simplifier, I'm going to demystify it because it's as simple as ABC. So principal is the amount originally lent or invested, while interest is a compensation for lending money. When you lend money, you are sacrificing. So you have to be compensated for lending your money, for sacrificing your money. Okay, you are taking a risk, so you need to be compensated for that. So that is interest. Principal is the original money you give. IFRS 9 explains why interest generally reflects consideration. So that is a time value of money, because of time value of money, because of credit risk, because of other lending risk and cost, and of course, because of profit margin. Okay, you have to make a profit from sacrificing your money. So in other words, it's just ordinary loan interest. Okay, so now let's look more deeply into the second question, which we say is the SPPI tests. Okay, to know how the cash flows look like, you have to carry out what we call the SPPI test. Now, how do you know that a particular financial instrument has passed the SPPI test? When do you know that a financial asset has passed SPPI test? As I said, SPPI is solely payment of principal and interest. So imagine this. If the contract only pays back principal plus normal lending interest, okay, you give a loan, you own a financial asset, isn't it? Now, let's say that the only thing you are going to get from it is going to pay you principal back at the maturity period. And it's also going to pay you contractual cash flows, which is interest. Okay? So if this happens, it means that asset has passed the SPPI test. Simple. That's what I told you. I said the SPPI is just a fancy term to intimidate people. It is as simple as ABC. So once a financial asset, once a contract passes this, once it pays back principal plus normal lending interest with no other thing, no other fancy thing, nothing fancy, no link to oil prices, no link to Bitcoin, no link to performance of the stock exchange, okay, no link to company profits, then it has passed the SPPI tests. Okay, now let's see when a contract will fail the SPPI tests. Good. Now imagine a different investment. Instead of paying normal interest and of course the principal upon maturity, the return you are expecting depends on some things like gold, the price of gold. It depends on the performance of the stock exchange. You know, what is the stock market index? It depends on that. Or it depends on cryptocurrency prices. So those cash flows are not simply principal and interest anymore. They are not like the first one where it is just payment of interest, and then principal upon maturity. This one depends on gold, the price of gold in the market. This one depends on the performance of stock prices. This one depends on cryptocurrency. This one depends on oil. You can see that it has lots of other complex adjustments. So because of that, it is not a simple contract. It is dependent on so many other factors. So because of that, we say those cash flows are not simply principal and interest. They are exposed to other risk and returns. So because of that, it will fail the SPPI tests. Now, an easy way to remember SPPI, solely payment of principal and interest. An easy way for you to never forget it, especially in the exam. It is not a perfect guide, but this will help you greatly in the exam. So ask yourself, does this behave like a normal loan? A normal loan is interest. You receive your interest every month, interest upon maturity, principal. Isn't it? That is a normal loan. If it behaves like a normal loan, then it passes the SPPI tests. But if the return depends on something extra, like commodity prices, like equity prices, like non-basic lending features, cryptocurrency, this one, oil, gold, and all of those prices. If it depends on those things, then it is not your normal loan anymore. In that case, it will fail, or it has failed the SPPI tests. So, as I said, it is not a perfect shortcut, but it is a great starting point for exam purpose. Next, let's put these two tests together, okay? Remember, we said two questions. Question number one, what is the company's business model? We said business model one, hold to collect. Business model two, hold to collect and sell. Business model three, when it fails the business model one and two, then it's every other thing that does not fit into category one and category two will all fall into category three. That's business model three. Then we say the second question is, what is the nature of the cash flow? And we say it has to pass the SPPI tests. So we want to put these two questions together. So before you even think about amortized costs, fair value, whether it's OCI or through POL, ask these two questions. Question one, why does the company hold this financial asset? Why are you holding it? Are you holding it to collect? Is the company holding it to collect and sell? Or is it going to fit into something else? Then, question two, are the contractual cash flows only principal and interest? If it is only principal and interest that make up the contractual cash flows, then it's a normal loan. And if it's a normal loan, it has passed the SPPI test. That's the solely payment of principal and interest. So these two questions drive the classification of most financial assets under IFRS 9. Now, what to expect in part 2 of our IFRS 9 Made Easy Masterclass. I want you to subscribe to Finance Simplifier so that you don't miss part 2 of the masterclass, because IFRS 9, as I told you, it's a very important standard and it is not something we can cramp into one class. So we're going to look at part 2 of it. But what to expect in part 2 of IFRS 9 masterclass, we're going to combine the answers to these two questions. And we're also going to discover how they lead to the three measurements at amortized costs, fair value through OCI, and fair value through profit or loss. So we're going to look at that. And once you understand that, once you understand the decision process, IFRS 9 becomes far less intimidating. Don't be intimidated by IFRS 9. So I urge you to subscribe to Finance Simplifier now. And of course, you watch all our videos. So remember, IFRS 9 is financial instrument. It took over, it replaced IAS 39. So for you to understand IFRS 9 very well, it is important that you understand IAS 32, financial instrument presentation. There is also IFRS 7, financial instrument disclosures. So that is also very important. So in the next class, as I said, we're going to take a look at the measurement. If you enjoyed this class, I want you to like, to share with someone, and don't forget to subscribe to the Finance Simplifier. Bye for now.